Hello, this is David Jensen with your April 1, 2023 Economic and Markets Update. The title of today's discussion is "The Banks Don't Have the Cash That We're Told." Hat tip here to Neil Kashkari of the Fed, who's been assuring us that the banks have adequate cash. Okay, first of all, if you like this presentation, please give the video a thumbs up. And these are the four platforms in which I post my thoughts. I look forward to further discussion in the comments section of the videos. All right, so the first slide, do the banks have adequate or hold adequate cash? Now, as I mentioned in our previous discussion, the fractional reserve banking system has an innate time duration mismatch. The banks borrow from savers, that's the deposit holders. They borrow from them short term, in that the deposit holders can request their cash back relatively quickly, but they make investment bets with long-term duration. For instance, mortgages, long-term bonds, etc., which are exposed to long-term impacts such as sustained interest rate increases, economic slowdowns, etc. Okay, let's take a look at the U.S. banks and savings institutions overall. There's $23.6 trillion of total assets held by banks and savings institutions, $17.7 trillion of deposit account holdings by the banks for savers. And in 2022, the last quarter, the fourth quarter, they had a $68.4 billion net income. So in round numbers, about $275 billion per year profitability. Now, it sounds pretty good, but there's some problems, as we'll see. The big issue right now is that the Fed has jolted interest rates higher. So after running 0% interest rates for the better part of a decade, the Fed has now jolted rates up to 5%. Assets held by the banks have declined by $2 trillion in value. You can see this article by the Hoover Institution. The U.S. banking system's market value of assets is $2 trillion lower than suggested by their book value of assets. So there's a hole in the balance sheet of the banks. And we're now starting to see the weakest banks failing as depositors withdraw cash. Now, let's have a look overall. Now, how much cash is in the banks to back the $17.7 trillion in deposit accounts? Let's look at JP Morgan's fortress balance sheet. I mean, let's look at the strongest bank, and it'll give us an idea. And then we know that if this is the strongest, that other banks and saving institutions would have lesser strength in terms of cash position. Looking at this tracking spreadsheet, I use it to follow the 5-year credit default swap rates for the various banks. Here's JP Morgan, and it says here that the JP Morgan's cash equivalent percentage of total assets is about 15.47 or 15.5%. So let's look. We could now go to the Wall Street Journal website for JP Morgan. So we see on their $3.7 trillion balance sheet, the cash, total cash and due from banks is $53 billion, or 2.2% of their $2.34 trillion of savings accounts. I missed the T there. But 53 billion, so they hold about 2.2%. But note, this includes cash held and due from banks. So having something due from banks is not the same as having cash in hands. You can have a setup here where every bank goes or holds savings for the other banks, and ultimately it's a daisy chain. And there may be impairments in there that are not indicated by this $53 billion. So I'd say it's less than 2.2% of the $2.34 trillion of savings accounts. Now, we've also got here the Fed funds sold and securities bought under resale agreements. So $501 billion for the combined total. So this is two components. Was QE cash from the Fed, which is saved at the Fed, so about $315.5 billion for JP Morgan, and then the overnight repo accounts, which are about 185 billion for JP Morgan. Now, the problems, as I mentioned, due from banks is not cash in hand. The QE cash, that's quantitative easing cash that's held by the Fed. The Fed holds over $2.2 trillion for the banks. And it appears what they're trying to do is, they printed the money, bought assets off the banks at face value, at book value, and then they gave the cash to the banks, who just went in turn and gave a portion of that back to the Fed to hold for them. So bit of a circular process there, but with the Fed holding it and then giving interest to the banks, that money is not in circulation in the economy, and it limits the inflationary impact somewhat of the $7 trillion that the Fed printed. So pulling the money from the Fed would cause an inflationary impact if it entered circulation in the economy. And the other element here is that the QE cash at the Fed that they gave to the banks generated about $85 billion in profit for the banks in 2022, and it's estimated it'll generate about $175 billion in profit for the banks. So again, that was money that was created digitally by the by the Fed, given to the banks for their assets at book value, which overstates their value, and then deposited back into the Federal Reserve. So let's look here at the Fed holdings owed to banks, and this is the sum of the two items that I identified here. You can see Fed funds sold and the securities bought under repo agreement. And as I mentioned, it's an attempt to limit price inflation impact of the QE printing by putting it back on the Fed's balance sheet. So we've also now had this new bank term funding program announced by the Treasury. It was created in March. But the BTFP, it only gives 12-month loans to the banks that are having to borrow money to give money back to cash back to the depositors. And it is borrowed by the banks at the Fed funds rate. So it's not a flat out give me. So this is an attempt to limit price inflation impact of the money creation. They're only giving 12-month loans, and the story is that the banks will have to pay it back at that point. But the other point here is that the cost of borrowing this money is also now going to have a hit on the bank profitability for 2023. Now, as savers pull deposits, it has a high cost to banks. As I mentioned, the BTFP borrowing rate for banks, they have to pay interest on it, and it's now 4.85%, as you can see here from the Federal Reserve. And so if they're pulling money from the Fed, borrowing it at 4.85% to pay back depositors, they're losing depositor money. You can see what the banks are paying depositors for the savings accounts right now. Essentially, they're paying them zero for the risk of holding cash in the bank accounts. Now, every dollar that banks borrow from the BTFP to meet cash withdrawals has a high cost to the banks, and we'll see that here in 2023 as we go on. Now, there's a next shoe to drop, which is default. We haven't seen appreciable default overall yet, but it has started. And the $2 trillion noted previously in terms of the balance sheet losses to the banks are only due to the Fed rate increases, which devalues the assets that they hold. So if they hold bonds or loans, that they're at lower rates and they're worth less as the interest rates rise. The total U.S. system has totaled at $93 trillion now. So if the Fed rate increase holds at 5%, it adds $4.5 trillion per annum of interest burden to the U.S. economy as the existing $93 trillion of loans roll and have to be refinanced. So it takes time, but it's a very real artifact in the economy. And the next shoe, as I mentioned here, is default, and we're starting to see that now that bank loan and bond defaults are coming. Small businesses are the first to default. So we see this headline from market insiders that private bankruptcy filings are blowing past COVID era peaks. as credit stress builds for small businesses. So the black line here is small business. The red line, the lower line, is the publicly traded companies, so seem to be larger. And the blue line here is the total. But we can see here that the small businesses, their default rate now is above the 2020 default peak. You can see it was down here for the small businesses, and it's well above that now. It will ultimately hit the profitability, both the profitability and the assets of the banks. Now, the crash that we have in process now is the work product of the central planners. This is I posted this on Gab and a number of other platforms, but I refer to this as the Federal Reserve's kill shot. So we see here the red line is the total amount of system debt. It rose to $93 trillion here in 2023. And we can see here, this is back to 2020 when the COVID scare was on, that the Fed increased M2 by 27% year over year. And now it's actually contracting it. And you can see that that is not on record going back as having been achieved well back to the 1960s. So we're at about -3% on their most recent release. And this contraction now is starting to cause this economic contraction and the rising default. We have an economy that was essentially addicted to 0% interest rates, and now we're starting to see the effects of that. Now note here that the panic money printing was for COVID, and we can see these infection fatality rates here. For those under 70, it was the bad flu for people in their 60s, and it was the flu for people in their 50s, and then negligible for the people younger than that. So it's a pity what we've seen now in terms of the consequences of that. Okay, now comes the central planner's solution for us. It is the central bank digital currency. So they're going to have complete control when they issue the CBDC. No more cash. They will be able to do anything they want. They can limit what you can buy. They can force you to use it by having only time-limited savings in your account. So, you know, if you don't spend it within a certain amount of time, it disappears, etc. Now, we've seen the work product of central planners in the past. And currency creation is far too important to be in the hand of central planners. Decentralized money, not currency, is the key to stability. And only silver and gold meet the definition of money. And those four requirements are must be durable, divisible, portable, and have intrinsic value. So the intrinsic value strikes out the naked cryptos that we have out there today. Okay, thank you for your time. Again, these are the four platforms where I post my information. I look forward to continuing the discussion there. Thank you for your time.